Real estate investment presentation, adjustable rate and price level adjusted mortgage loans overview. Get ready because we're raising the stakes with real estate. Patterns of variable payments. In prior sections, we took a look at the fixed rate mortgage, which will have a fixed rate, typically a standard payment over the term or life of the loan then being fully amortized at the end of it. One of the most common terms being the 30-year fixed rate. As we now go to more complex patterns, we always want to be comparing and contrasting back to, in essence, the standard, looking at that as our baseline, and then seeing what the variations will be from it and the pros and cons that will come along with those variations. We'll be looking at the adjustable or floating rate mortgage, or ARM, and then the price level adjusted mortgage, or PLAM. And as we do so, remember, we're going to be referencing Investopedia. That's a place that you can look up investment-related terms and get some more information about them. So let's start off with the standard, the fixed rate mortgage. This is the baseline, what we want to have a good idea of. We took a look at them in prior sections so that when we move on to something new, something different, we have that baseline to move from. So a fixed rate mortgage is a home loan with a fixed interest rate for the entire term of the loan. So the rate's not going to be changing. You got the fixed rate. In other words, sometimes called, you locked it in. You locked in the rate. Even if interest goes up in the future, then you got that lock in. So once locked in, the interest rate does not fluctuate with market conditions. So in other words, if the market goes up in terms of the market rates and you locked in, that's when it could be a favorable condition. Borrowers who want predictability and or who tend to hold property for the long term tend to prefer fixed rate mortgages. So obviously, if you have a 30-year mortgage, then you don't really know what's going to happen within 30 years. That would be a long time frame in order to figure out what's going to go on. If you plan on living in the home, staying in the home for that entire time period, often you will tend towards wanting a fixed rate mortgage at that point to kind of lock in those conditions. So most fixed rate mortgages are amortized loans. In contrast to fixed rate mortgages are adjustable rate mortgages whose interest rates change over the course of the loan. And that would often be the case in adjustable rate if you got if you're low on cash on the front end and you think that you're going to have more later on, then you might have an adjustable rate. Or if you have some kind of investment kind of purposes that you're taking into consideration, possibly not looking to hold the property for the entire loan term of, say, 30 years, then there could be options for the adjustable rate. Clearly, there will be pros and cons when we move from the standard to basically other type of formats, such as the adjustable rate, a fairly common move from the standard rate. Now, clearly, from the borrower's perspective, one of the objectives of an adjustable rate mortgage as opposed to a fixed rate would be to get more favorable terms, lower interest rates, and lower payment amounts, at least for some period of time, at least up front in the mortgage. Why would the lender be able to do this? The lender, in essence, is going to be transferring some of the risk of the uncertainty in the future, especially related to possible increases in interest rates in the market and inflation in the future, transferring that risk to the borrower in exchange for the ability to lower the interest rates up front. So that's going to be the general idea. The risk related to market conditions changing, possibly interest going up, inflation going up, being transferred from the lender to the borrower, and that allowing, due to the less risk, the lender being able to give more favorable terms, lower interest rates, and therefore lower payments. That's generally the idea. Now, notice that the adjustable rate mortgages, or ARMs, got kind of a bad name when used in the recession of 2008, when there was basically a decline in the real estate market at that time. Obviously, there's a lot of other factors involved as well. It's not just the tool of the ARM that is the problem. It's the idea that, was it used deceptively? Are people understanding what they're getting into when they go into the ARM? Are they using, these teaser rates that are going to be problematic? And the secondary market with regards to selling the mortgages and so on. There's a bunch of factors went into that. The basic idea here, however, is that the tool itself is sound. You're making a trade-off of one thing for the other. You're taking on more risk in order to get more favorable terms. That makes sense. However, the fact that you're taking on more risk means that you need to be able to understand what those risks are better in order to make a good decision as to whether it be right for you to do or not. So an adjustable rate mortgage, or ARM, is a type of mortgage in which the interest rate applied to the outstanding balance varies through the life of the loan. So now we're going to have this adjustment, obviously, to the rates throughout the loan. Adjustable rate mortgages generally have caps that limit how much the interest rate and or payments can rise per year over the lifetime of the loan. So the general idea is, you're going to tie the loan in essence to an index. The index is going to give some idea of the market conditions. The index rates will then change over time, and then your rates will basically be pegged to or tied to the index, being some margin above the index. And then on top of that, so if you do that, then that general idea would be transferring the risk of the increase in the inflation rates and in the interest rates over time, again, from the lender to the borrower. Now, in order to limit some of the risk, to take some of the risk back off the borrower and put it back on the lender, you could then say, let's apply some caps and say, although it's adjustable, we're going to say the interest rate cannot go over so much per year, or it can't go over so much for the lifetime. Or possibly you have a payment cap saying that we're only going to allow the payment amount to increase so much over time. So an ARM can be a smart financial choice for home buyers who are planning to keep the loan for a limited period of time and can afford any potential increase in their interest rates. So clearly, you might, be a good option if you're planning on having it for a shorter period of time. And in the event that you're planning that if the rates were to go up and you have a worst case scenario kind of thing, that you're okay with that, you could basically cover that. So price level adjusted mortgage, or PLAM, these are going to be a little bit less common than the adjustable rates, but they're something that you might come across, and they could have their pros and cons depending on the circumstances. The same concept basically applies here, in that you're a borrower, you're looking for more favorable terms, lower interest rates, and lower payment amounts, and so you possibly deviate from the standard 30-year fixed type of loan. And in this format, instead of adjusting the interest rate, what they're going to do is try to look for a factor of inflation. And at the end of each year or each period, they're going to be looking at it and adjusting the ending balance according to this inflation calculation. So let's take a look at that. And these make, of course, a lot more sense doing practice problems. We'll do many practice problems so you can get a better idea of what's going on here. So with a price level adjusted mortgage, or PLAM, the bank or lender revises the home buyer's outstanding principal based on a broader inflation rate that is derived from a price index. With a price level adjusted mortgage, or PLAM, lenders receive back the loan principal, a determined interest amount, and an additional price that covers the cost of inflation. Before opening the price level adjusted mortgage, PLAM, the home buyer and lender will reach an agreement on how often the lender is to make inflation adjustments. In most cases, adjustments happen monthly. Price level adjusted mortgages, PLAMs, are not suited for borrowers living on fixed income. So the idea then being you got the same interest rate that is going to be applied, but they're going to be factoring in inflation. Now, what is inflation? Inflation, if we're in a time of inflation, it could increase market rates as well, but inflation is generally the concept of the purchasing power of the dollar is going to go down over time. So if you're a lender, of course, you're concerned about inflation, because if inflation happens, the purchasing power of the dollar goes down, and you're going to get paid back the loan in the future with dollars that are worth less than they were when the loan was taken out. So in order to remove that problem for the lender, the fact of inflation, they're going to try to work that into the balance, not by adjusting the rate of the loan, but instead by actually looking at the loan periodically, monthly or yearly or something like that, and then adjusting the balance of the loan for inflation based on some kind of price index that they're going to be using to calculate. So in essence, you'd be determining what the index would be to use to figure out what the inflation is, and then applying that calculation for inflation on a periodic basis, and then actually adjusting the price level of the loan periodically. As you do so, then you recalculate the payment each time based on the new loan balance and the same interest rate. So we'll do some practice problems on this one. It's a little less common. Sounds kind of complicated, but if you look at it a couple times, it's fair, it makes sense. It's fairly straightforward once you calculate it a few times. Now, obviously, the risk here is going to be dependent on what happens with regards to inflation. Remember that inflation, if we're talking in U.S. terms, and most countries, of course, want to keep inflation generally under control. If you're the Fed, if you're the government trying to regulate the currency and the inflation on it. In the U.S., they generally shoot to have inflation, meaning they're shooting for like 1 to 3%. So you would expect if they did their job right correctly, it would be like between 1 to 3% or something that you can assume inflation to be. You wouldn't generally consider, you can ask what would happen in a deflationary period, but you wouldn't normally consider there to be deflation. It's possible, but you would expect the inflation to always be going up at 1 to 3%. Now, again, that's kind of what they're shoot for, but it could go out of control. It has in the past. It almost certainly will, at least at some point in the future, go above that point. And obviously that would be the risk, more of the risk that would happen. You can kind of say what would happen, best case scenario, if the inflation was steady, what they actually are looking for, 1 to 3% or something, and what would happen if things got out of the steady period to getting on, higher inflations, which would cause more problems generally as well, and then look at your best case and worst case scenarios in a similar fashion as you would with a variable interest rate.